Okay, so just going to make a swift start. First of all, let me just say good afternoon to everybody. So I'm happy to be back here at DC. So last time I was here was about 5 years ago, right? And we attended a conference. It was all about trade between US and Africa. And between then, obviously, many things happened, right? We had a pandemic. We obviously have as well the war in Ukraine. And something that was already there but still has changed is the climate change emergency, right? And definitely we can say that things have changed. And I can see that in my own personal life because more than 10 years ago, I was already making my shift, from automotive into renewables energy. And I was kind of one of the first advocates in my family. And then fast forward, what do we see now? So last week I was talking to my brother-in-law. So he's a very successful management consultant. Now he's talking himself to be a chief sustainability officer. Why? Because he's also concerned by the situation. And he definitely wants to play his part as well, like many of us, right? And he wants to make sure that he can find a way to bring finance into this world. And it's very much needed. And I was just talking to Alina, and one of the things that she told me is that her company, Standard Chartered, released a report recently, about just in time. It was talking about the finance necessary if all the emerging markets were to move into net transition and meet their long-term sustainability goals. So we're talking about 95 trillion, right? Dollar. Obviously, it's important to to mention what the currency is. And if they were actually able to, if they were going to fund it themselves, it means that if you talk about the household consumption, it'd be 5% lower, right? Clearly, that's an issue. So that's why we want to talk about the role of private sector here. And that's what I'm going to be discussing with you, Lena. I'm just going to have a sit down here. So what we're going to do is just going to have a few questions with Lena. And after that, I very much would like you to be part of the conversation, if that's okay, right? So, Lena, so obviously you are very much established. And I usually like to start by reviewing some terms because we all talking about just transition. And I know that because talking into a different side of the equation, it doesn't always mean the same thing. I wanted to know from you, Lena, what do you understand by just transition, first of all?
So thank you for that introduction, Tony. I think you've set the scene really well. So from the perspective of where we sit as a bank, just for the benefit of everyone, we are a bank that is in emerging markets and a lot of developing economies that rely heavily on fossil fuel to lead and actually quite literally fuel their economic growth. And what that means is that we cannot just turn the tap off and just say we're not gonna work with you anymore. We're not gonna fund these projects. The way that we look at it is that we have a responsibility towards helping these economies transition to cleaner methods, but at the same time still contribute to their economies, to their growth, and finding those elements of projects that can help them with that transition. So a just transition is essentially literally just that. It is helping these economies get prosper and continue to grow, continue to create jobs, continue to serve their very much growing populations while they are on a path to a transition to a cleaner economy.
Thank you very much for saying that. And that's important because last week I was at a conference in Germany, and there was a lot of African representation there. That obviously part of the emerging market. And clearly some of them were complaining about the fact that in wanting them to transitions doesn't mean that we don't want them to develop. That's why I wanted you to sort of revisit this term of just transition to make sure that we absolutely understand the same thing. Now, going back to you, so I just wanted to, you talked about the finance, and I know that you have a very extensive career, right? 15 years in banking, maybe more. So where is the finance gonna come from? So do you have some with you today?
I don't come with a check, but yeah, maybe. I mean, the finance is going to come from different aspects. I mean, if you look at how the economy is developing, or the sustainable finance market is developing, it has been growing quite extensively over time, and it's been actually growing exponentially over the last couple of years. What that means is that we have been seeing a tremendous influx of capital that is now demanding greener and more even social, more sustainable, we call assets, whether it's actually projects that you're investing in as an investor, or as a lender, you are essentially looking for those assets to put them on your books. So we have made a commitment to get to net zero from our financed emissions, which is our scope 3 as a bank, by 2050. And what that means is, and a lot of institutions have made similar ambitions as well. What that means is that we have to work with our clients, we have to work with our stakeholders, with our communities, with our regulators, to kind of create the best way for us to increase our asset book ratio to more sustainable assets that we can put on our books. So what that means is that this is creating a market that is demanding more of those assets, and therefore is creating that direction of capital towards things that actually matter the most, and towards countries and economies that need it the most, because they're going to be the most impacted by climate change.
Okay, excellent. And you mentioned that before, so as a bank, so clearly you've taken quite a strong stance, right, so with regard to this issue. So, and I just wanted to know, but the thing is, one bank is not going to make a difference, right? You need a clear movement there.
Yeah.
So what would it take, obviously, to make developed finance a reality? Because I'm sure you already have an idea, because you're sort of a sizable bank, for at least operating clearly in the African market and other region as well. So, but what would it take to really make it a reality, so that we can see a movement of people that want to follow your footsteps?
So I think there are several elements to this, and I completely agree with you. Us as a bank on a standalone basis, we're not going to be able to achieve the $95 trillion worth of funding that is required to transition economies. Having said that, actually, a lot of work that we do with our clients, who are also banks of ours, regional, local banks in different countries that we are present in, is actually raise the profile of sustainable finance and what they can do, what it means, how it impacts them, where they can direct their capital, and what are the market standards, the market norms that are getting them, that would mitigate risks of greenwashing and other things. But I think what's really important is, you've touched upon this in the beginning, where if we were to just rely, or if developing economies were to rely solely on raising taxes or doing their own borrowing in order for them to be able to fund their transition, there will be an impact on household consumption. Households will be $2 trillion poorer on an annual basis between 2021 and 2060, which means that climate is not going to be a focus anymore. So what that means is crowding in the private sector and helping developing that stage for the private sector to come in and fund these projects, looking and identifying. I saw a couple of sessions today on how that is becoming a business opportunity, and it really is for different industries, different companies. But the way that I would break it down is that I think there are three main pillars, if you like, when it comes to how you help crowd in the private sector. And the first pillar is strategy. So you have to have a strategy that is coherent across industries. You can't have a company existing in silo, having their own sustainability strategy, and then they cannot connect to the right infrastructure, for example. The second one is policy. So policy will create the standards and the right climate models for banks and lenders, specifically because we are regulated, we're heavily regulated. We are required to put on the side risk-weighted assets for any financing that we do, and therefore any financing that we provide to kind of the developing countries, which usually have lower credit ratings, means that our pricing is going to be expensive. And that is a result of policy. So having the right policies in place, having the right modeling of these things in place is really important. The session, 2 sessions before ours, we were talking about the carbon markets. So putting a price on carbon is actually going to be extremely essential in order to show the true value or true valuation of fossil fuels, and to make the newer technologies more economically viable. And the third pillar is financing. So we will need innovation. We will need to come up with products that cater to these types of requirements by companies, by economies as well. So one of the best examples of that is blended finance, which essentially gets, crowds in the private sector by bringing in the public sector in order to finance certain projects. And that's not just in the form of, bringing in the multilaterals and the DFIs, but that's not just in terms of funding, but more importantly, in terms of technical assistance in order to develop the right due diligence that will bring in that comfort from investors that they can come in, and financiers as well, to come in and fund these projects. So I think, in summary, 3 pillars that I think will play a big role: strategy, policy, and innovation and financing is what will help us, fuel that just transition.
Excellent. I think I'm just going to take one more question before I can open the floor, because I'm sure there's lots of questions that you're having. So you're giving us 3 pillars that are fundamental from our understanding. So the key question I want to ask you, normally when we talk about emerging markets, right, so we talk about more than 3 billion people. Do you see differences in those emerging markets? Because whether you're talking about India, or you're talking about African countries, or you're talking about MENA region, it's not the same thing. So does your 3 pillars apply equally for all of these people? I
mean, the 3 pillars are just kind of like a generic, very broad basis. But I think they apply to the different markets. The interesting thing about these different markets is how each one of them operates differently. There are different priorities. If you look at MENA in comparison to Africa, there are different priorities there. There are different requirements. There are different demands by the communities, by the citizens as well. So I mean, they probably all apply to a certain extent, depending on where you are. Maybe some of them are more kind of prominent and need more focus than others. But I think they kind of create that kind of working model. And I'm sure there will be other pillars and other ideas that could come into this to kind of catalyze the transition and financing it as well. But I would look at it as just general direction to get things to where they actually need to be.
Excellent. I think we have about 10 minutes or so, maybe less. So just to take some questions. I don't know whether there's some question on the floor, so there's got to be some questions. Anybody? So, no? Okay, there's a gentleman on the back. Two hands. Normally the first one is already the most difficult one, and after that, is easier.
Dan Kamen from USAID and University of California, Berkeley. Got a question. So I've been a teacher in this field for a long time and in and out of government. And when I started, the sustainability degrees that were offered at kind of the known universities were largely refugees from the physical sciences and largely men. And that has totally changed today. We have, our classes are flipped, and so the amazing applicants trying to work at U.S. government jobs, government of Nigeria jobs, women are very much in the lead. One of the questions I have for the just transition is, how do you do financing that supports diverse entrepreneurs, whether it's women, minority groups, whatever else, and not get it pigeonholed in the end so that it is a set aside and it's not part of mainstreaming economic projects? Because I've seen so many where there's interest, but it ends up being, it's a club, it's a good club, but it doesn't lead to the kind of Wall Street, Fleet Street finance offices. What can you do on the financing side to make the path to justice and equity one that's a real on-ramp and not a sideshow?
I'm happy not having to respond to that. So
yeah, that's a good question. I'm glad that you brought it up, because it was one thing that we didn't talk about. I mean, one of the elements of the just transition is the S in the ESG, right? It's not just fortunately or unfortunately, I don't know how you'd look at it, but climate is at the center of the world stage right now. It's all about climate. It's all about greenhouse gas emissions. But then us being in places like in Africa, the social element is extremely important. I mean, I can safely say that a lot of the work that we do in terms of financing a lot of these projects in Africa are social. They are your sustainable infrastructure. They are your access to water, access to affordable housing, healthcare, education, etc. So that's one angle of it. But then the other angle of it is the diversity and inclusion angle as well. And one of the things that we look at is, how can we direct capital to women-led SMEs, for example? How do we incorporate? So one of the instruments in sustainable finance is sustainability-linked loans or sustainability-linked bonds. And some of the KPIs that we put, I mean, the way it works, just very quickly, is that you put in KPIs for clients, and you say, this is what we would like you to achieve based on these targets, etc. And then you get a margin ratchet, an incentive, or a penalty. One of the things that we have been seeing quite a lot of is women in senior management, women on the board, in some of the sectors that are kind of male-dominated, like in engineering, in aerospace as well, for example. You'll see that male-dominated angle there, but there's more and more focus on bringing in, female scientists, female engineers as well, and we put that as a KPI actually for clients. So it's a big focus for us because of the fact that it is because of the fact of the markets that we are in.
Thank you very much. Thank you, Daniel, for the question. I'm just going to take one more question. We may have to wrap up after that. Yes.
Okay. Very quickly, thank you. Fascinating. Anna Georgieva with the World Bank. We struggle a lot with having projects prepared so we can invest in them. Could you tell us a bit more about how you support your clients to get to bankable projects?
Yeah, I mean, it's a very good question because, I mean, the reason that we exist as a bank or any bank is that we want to invest in projects that actually make sense. This is a business at the end of the day, and therefore we see a huge business opportunity in a lot of these projects because we see the returns, we see where the capital is going, and we see where that's going to drive economic growth, and therefore. One of the main, or some of the main things that we look at are the fundamental, is the fundamental credit of a project. The fact that it works, there are the right kind of restrictions in place, the right structures in place. If you're looking at a project finance facility, you have the right offtake agreements that are non-cancelable, non-negotiable, all of that stuff that is in place. Obviously, it depends on the projects, and every project is different. But that is really important. The way that we are kind of, we look at a lot of these kind of green or sustainable projects is also driven by what we have in our Green and Sustainable Product Framework, which is a public document that shows the criteria of projects that we will look to invest in, that we will look to go after, and where we see that those could potentially be classified as green or sustainable, and then or social. And then there's also the angle of transition, where there are certain projects that we will go after, that we will try to finance, that we will try to make it work in order for us to help our clients on that journey. The other angle that we do is ESG Advisory, which is really interesting because that's an area where we are supporting clients in how they think about their businesses, their business model, what is required, how to attract the right financing from investors or financiers in order for them to get the best outcome from a cost of funding perspective and demand perspective.
Excellent. I may have time for last quick question. I think there was a hand. Yeah, quick one.
I'll just speak up. Claire Casey from Economies Impact. We spend a lot of time thinking about the SDGs, and in that community, there's a lot of fear that actually ESG taking off might create disincentives to invest in least developed countries and actually hold back a just transition in some of the most
vulnerable markets. What's your perspective on that? Are they working together, or is there a risk there?
No, I don't. I actually don't think there is a risk. The more time I spend in this space, the more I feel that it goes hand in hand. It depends on the countries again, but I think, I have this conversation, this debate all the time with my friends as well about, you're asking all of these countries to do all of these great things, but then they have other priorities. They want to create jobs for their people. They want to send their kids to school. They want to put food on the table. And you're basically thinking, 30,000 feet above, right? But I think, there, again, depending on the country, I think there is a huge business opportunity for these local economies to spearhead their industrialization, if you like, their growth, their the economic aspect of their countries, because they can. A lot of these countries have a tremendous amount of resources. It's not just fossil fuels that's going to fuel economies. Yes, we will continue to need that, and that's part of why a just transition is important, rather than a complete cutoff and we're just going to do green and renewable energy. And I think that there is a tremendous opportunity. If you look at places like in Africa, for example, there's a huge opportunity because it's a place that has solar, that has wind. That's a place that's going to have nature-based solutions for the carbon markets. It's going to be a source for carbon credits. So looking at these new markets rather than the traditional markets, I think is going to be key. If we just look at things conventionally, then maybe, yes, you're right, it's not going to be there. It's probably not going to be supporting economic growth, but we need to find those new markets. We need to find those innovative solutions. We need to put in place those proper policies in order for that to not be the case.
Thank you very much, Lina. I think you've given me the perfect word for the final say, because I have to say that a lot of the time when we're talking about investing into the just transition, we're looking at developed market, but not emerging market enough. And I think that as I was talking to my brother-in-law, saying that actually now he find the time now to move into the sector and to convert himself from management consultant into CSO. I like to see more people moving into finance, but also not stopping the developed market, but going to emerging market. That's what for me the just transition is, just to make sure so they can grow as we can all grow. So thank you very much for that. And Lina, it was a pleasure to talk to you.
Thank you, Tony. It was a pleasure being here with you. Thank you, everyone.